The other thing that really makes me bearish on the metals is how expensive the U.S. stock market was. 2.3 times GDP became the economy. It's still way too expensive. It's just starting to correct. So for things like the industrial metals to do well over the next who knows what period, the key theme you have to have is, first of all, you probably have to have the stock market going up. And I think we just started the first 50% drawdown, the third 50% drawdown since 2000. There's good reason for that. Global energy crisis will do that. Highest prices in about 100 years will do that. And another thing you have to have for the metals to do well is China doing well. And China's facing a world that's heading towards recession. So metals give you a great run. You're supposed to get out and say thank you is the way I see it.
Since the onset of the conflict, gold has lost approximately 12% of its value. Rising energy prices are amplifying inflation risks and reinforcing expectations of higher interest rates, which limit demand for the metal. Moreover, gold is not fully fulfilling its traditional role as a safe haven asset. Some investors are being forced to unwind positions to cover losses in other market segments, adding further downward pressure on prices. Senior Commodity Strategist at Bloomberg Intelligence, Mike McGlone uderscores that gold has reached extremely rare historical highs compared to long-term averages, making this a potential once-in-a-lifetime selling opportunity. He argues that gold, silver, and even Bitcoin have likely topped following a historic run and warns that markets may now be entering a prolonged period of mean reversion. He outlines why he sees gold falling toward $3,000 following the ongoing market situation. With rising recession risks, weak conditions in China, and expensive equity markets, the upside in metals is limited, and the better strategy now is to step aside and protect gains. In his assessment, McGlone notes the Fed is likely to ease as markets weaken, signaling a shift from the inflationary boom of 2020 to 2021 to a deflationary phase. He explains that major assets like stocks, gold, and Bitcoin have already surged significantly and now appear overvalued, with most bullish factors already priced in. Concurrently, Mike McGlone says stocks are entering a tougher phase, with a potential downturn driven by high energy prices and recession risks. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Mike McGlone's recent interview.
So there's few times in a career you can say that you've sold or peaked or have an asset you were bullish on and it gets to a level that's the highest versus a 60-month moving average, the highest ever versus the Bloomberg Commodity Index, versus a 200-day moving average in 40 or so years, since 1980. So that's almost 50 years. It's very seldom you can make those statements. And that's the key theme about gold is I spoke to people in January and February I hadn't spoke to for decades. Most of us have been bullish gold forever. And the prudent thing was to just say, thank you, give it back to the market. So to me, gold told the gold selling opportunity still potential this year is of a lifetime. And these things, how they always work is what you're supposed to be selling when they're yelling. The key theme, though, is now what's happened is gold switched from a traditional store of value when it traded at lower volatility, the S&P 500. Now 180-day volatility is over 2 times the S&P 500. So all that means is S&P 500 goes down, gold goes down harder. It's just the way it works. It's the way markets work. Silver, too. Silver is the devil's metal, did what devil's metal usually does. It sucks you in, puts a high around 125, and I think it's going to languish below these highs we put in this year, around 5,500 in gold and around 125 in silver for years. That's just the way it usually works. The key theme is it's all the metals. It's copper. And so I'll go back to this. In 2016, 10 years ago, I started at Bloomberg, and I asked the index team to start an all metals index, partly because I've always been bullish metals. Metals are the best place to invest typically in commodities. You don't have contango and backwardation to worry about. You don't have to, you typically have the best performance. You don't have to worry about storage typically, most notably in the precious. I've always loved the precious, gold, silver, platinum, palladium, but they just got too expensive. And that's the key thing to remember about all commodities. You have supply, demand, and price. Supply and demand don't move much, but price does. When price shifts exponentially like this, it shifts everything. And to me, that's what's happened. And it's also the way it happened. So the feeling I got in metals later last year, I was a little bit early calling for a peak, and certainly this year was very similar to what I saw in cryptos a year ago. It's classic peak bull market stuff. To me, gold looked basically front ran this event that happened this year. Last year's rally was wonderful. I got lucky to be on top of that one, but it was the best rally since 1979. It didn't make sense to me. Now it does. What's happened to Iran? Now, what's happened since Iran war? Gold's gone down. Most of the metals have gone down, partly as the world faces a potential global recession with crude oil. Doesn't make sense in gold typically, but all the industrial metals it does. That's top. And the key thing you have to think about going forward, let's talk about industrial metals. The thing that's really bothered me for a while is these deflationary forces that you see in China. 1.82 in that 10-year. Now it's starting to matter. We see severe deflation, and now they're having problems exporting that to the rest of the world. And the other thing that really makes me bearish on the metals is how expensive the U.S. stock market was. 2.3 times GDP became the economy. It's still way too expensive. It's just starting to correct. So for things like the industrial metals to do well over the next, who knows what period, the key theme you have to have is, first of all, you probably have to have the stock market going up. And I think we just started the first 50% drawdown, the third 50% drawdown since 2000. There's good reason for that. Global energy crisis will do that. Highest prices in about 100 years will do that. And another thing you have to have for the metals to do well is China doing well. And China's facing a world that's heading towards recession. So metals give you a great run. You're supposed to get out and say thank you is the way I see it. The Fed's probably going to ease a lot as risk assets because typically it's look at the cycles, the lessons of books like The Price of a Time by Edward Chancellor and Boom and Bust by Quinn is we go through cycles. They're mostly inflationary and post-inflation deflation. And typically the inflation comes on the back of massive money pump. We had the biggest money pump in history in 2020 and 21. That's why McGlone was so bullish gold and Bitcoin. Poof, that's ending now. Stock market's too high, gold's too high. We've seen the rally. Everything you said was stuff that's happened. Now I have to look forward. So let's look at the geopolitical part of gold. Part of the reason I was really bullish gold started with the unlimited friendship. Well, that started, but that was something that really accelerated in 2022 between President Xi and President Putin. Now, what have they lost so far? They've lost Syria. They're bogged down into this almost 5-year war in the Ukraine. They've lost Venezuela. Iran's just a matter of time, and Cuba's next. You see what's happening is also in de-dollarization is let's look over at cryptocurrencies. De-dollarization is kind of silly. Where are you going to go? You can go to the yuan. You can try a brick currency. You want to use the euro? Well, good luck. They don't have 11 aircraft carrier battle groups. That's proving it right now. Yeah, it's a little bit of a battle of bulge right now in Iran, but U.S. will clean that up. The bottom line is what you see happening in cryptos. The most significant development in cryptos is the proliferation of crypto dollars. 90% of all the crypto dollars or crypto stable coins track the dollar. Why? They happen organically because it's the only place to go. I mean, and globally, people will trade cryptos in dollars. Why? Because it's the base currency on the planet. So I'm not worried about that. I just like to point out it's just a little lesson in life. When gold goes to 2 times its 60-month moving average, you better be a seller. Bottom line is markets prices have shifted. They went exponential, and everything you said has been priced in, and all that demand and supply stuff, even central banks are going to flip on the other way, just the way it usually works, question of time. Now, I'm not saying it's made a complete, I think it peaked. We can still get there, but these prices here, that rally we had for the last few years, that appreciation, the protection of your wealth is done, if history is a guide, for a decade. At the start of last year, I was overweight. I'm not overweight, but overweight. And I saw the inklings for gold to break out. Got lucky and just never thought it went that far. But now, the start of this year, my overall bias is that stock market volatility in the U.S. is too low. It's still too low. 180-day volatility is still about near a 10-year low. And we're just fluctuating. That's going to go up. It's just a rare environment to have the mercurial president we have, to have this global discombobulation and have raging volatility in metals and energy and not have it trickle over the stock market. It's just getting started, but it's also happening in a historical case with some measures of the U.S. stock market nearing 100-year highs. We had credit spreads near 20-year lows. This is the flip. This is the switch, and we're way overdue for it. So we haven't had a down year in S&P 500 total return. We've only had 2 since 2008. This year's going to be a down year in my view. It's already started. We might fluctuate, but it can't be easy. But to me, it's just getting started. But we have a worthy cause now, a worthy catalyst, and that's just the spike in energy prices and the potential trigger a global recession. But the thing is, even if the strait is resolved overnight, we still have to deal with what's happened. The data from this period, from a consumer standpoint, from a capital budgeting period, when we look back at this from a few months, is going to be horrible. And to me, it's just getting started.
During the interview, Mike McGlone notes gold has reached extreme valuations and that most bullish factors are already priced in. This view is supported by recent news showing that gold has actually fallen sharply despite geopolitical tensions, marking its worst monthly drop since the 2008 financial crisis, as rising inflation and interest rates reduced its appeal. He further mentions that rising energy prices are driving economic slowdown, and current events align closely with this. Reports show the ongoing conflict has triggered a major oil shock, pushing prices higher and raising recession risks globally, with warnings that this could lead to a bear market and weaker consumer demand. At the same time, gold has been declining even during the crisis, reinforcing his point that it may have already peaked and is no longer reacting as a strong safe haven. Overall, McGlone believes markets are entering a high volatility, 2008-like environment where active trading, not long-term holding, is the better strategy. Let's jump into the interview.
The difference is right now, there's certain valuations that matter. And I pointed out when people you're talking about, people give me a hard time about talking about prices. The thing I have to point out is the price has moved. The reason we have higher valuations in gold for a lot of central banks is because the price went up so much. But the bottom line to remember here is I have data in my Bloomberg terminal back to 1973, 50 data years. If you take gold divided by gold's competition typically is U.S. Treasuries, one of the main things. And at just a few months ago, gold reached the lowest versus a basket of U.S. Treasuries. I'm sorry, the highest versus a basket of U.S. Treasuries, and Treasuries were the lowest versus gold since 1982. So there's valuation issues now. Everything you said is priced in. Wonderful. Thank you. Now, here's also a thing what's going to happen in the war. I'll give you a pretty significant thing. One thing the U.S. military is good is, as Mr. Trump said, you be careful what he says, but what they can do is reducing a country to the Stone Age, just pounding it hard. Now, that's what's happening. He said 2 or 3 weeks. We'll see it again this weekend. And at some point, they'll probably just, what's been the major mistake is letting the strait be closed. Now, that was one thing I got wrong. But now that it's happened, what does that mean? Crude oil is kicking into a global energy crisis. What does that mean? Wealth destruction's kicking in. We're seeing major capital budgeting decisions declining. Consumers are pulling back. The whole market's starting to, and this is a classic signal like I remember in 2008 when crude oil reached 145, when 9/11 hit. It's just a classic sign to cut off consumers and for some wealth destruction. Now, that's happening, but I think we probably should best to disagree. The pointed thing about gold is when it gives you those kind of profits, history proves you're supposed to take them. And that was what I've been saying for a little too long. I was way early in cryptos, and that's the same arguments I'm hearing you made to me. Like the cryptos people were so angry at me a year ago when Bitcoin was about 100 and now it's at 68. I said it was going to drop to a drop to zero. It's not there yet, but that's the same thing that's happening. It's just classic nature of markets. You point out all the fundamentals, but the bull market's over, in my view. And all those fundamental things are if statements and pretty negative things. So let's look at markets. What's what markets are telling us? Look at crude oil. This is all about crude oil. The December crude oil future in the U.S. right now, $71 a barrel. Now, the front contract's 111. That's significant because that's going to be the front contract by the time we get to the midterms. By the time we get to midterms, if crude oil's 50 or lower, I think it's going to be 50 or lower, then Mr. Trump gets exactly what he needs. He needs lower energy, lower interest rates. He needs a stock market higher, but I think he's going to get recession. But the market's already pricing forward for this situation to be resolved. So if it's not resolved, why is gold going down? Because gold already went up too much. But those are if statements. If this becomes a quagmire, if there's any kind of something like fallout or nuclear, sure. But those are very low probabilities. And to me, gold was the right trade last year and it's the wrong trade this year. So I have to admit, I'm not original. I just heard that one years ago when I was trading it and lost my hair. I think silver's going back to 50. I think I put an enduring peak. Silver's an industrial metal. So you have to hope that China does something well, and everybody points out solar panels. I get it. I remember pointing out solar panels 15 years ago when it was only like 5 to 10% of total demand. Now it's 20%. That was the time to accumulate silver. But the lesson you learn in silver is never buy it after it goes up at the pace it did, ever. It'll ripped your face off. So I think it very similarly goes back to 50. I think it languishes for years, maybe between 150. It could make a new high, but the appreciation now, it's a great trading environment. Buy around 50, sell around 100. But the accumulating of a bull market going up, I think it's just over. It's usually the way it works. But again, it's industrial metal. And the bottom line for silver is you have to hope stock market goes up. It's industrial metal. And China comes out of this deflationary period and does very well. And just like I said, my bottom line is that all that volatility is trickling over the stock market in its early days. It's only down 3%. I expect it to be down almost a third this year in the S&P 500. Now, that's part of my macro case. I made it too early, made it earlier. But after what we described, what happened in gold last year, what's happening in cryptos, gold reaching, the lowest, the highest level versus treasury since 1982. I stick with my bias this year. It's just hang out in treasuries and get away and just trade. And my trade levels here's my levels though. I've been putting that for a while, been using prudent shorts because I think I have very sense that this is like 2008. It's going to be a high volatility year and only responsive traders would do well. Don't buy and hold. So the levels I had so far this year were silver above 100 is a prudent short. Now we've already dropped 30% from that level. So you don't want to be too aggressive. Copper above 6, I think was a prudent short. Bitcoin above 90 was a prudent short. The stuff is adding up. But one thing I'll end with is here's a good leading indicator for post-inflation deflation. The number one measure of heat, electricity, source of heat, electricity, and fertilizer in the U.S. is natural gas. And U.S. natural gas was up 100% in January, and now it's down 24% in the year. On a one-year basis, since it's a seasonal contract, it's down 30%. It predicted what crude oil would do in 2022 when it spiked and went down. Natural gas is ahead. It's a higher volatility market. It's telling you where things are going. It's seeing that potential demand destruction, and it's seeing that massive excess supply. So as a commodity guy, broad commodity guy, I look at the metals are wonderful. The thing is, in February, that Bloomberg All Metals Index, it reached the highest ever versus a Bloomberg Commodity Index, and it's reverting now, and that usually means it'll probably peak for a long time.
With tightening financial conditions, elevated energy costs, and growing recession risks, markets could be entering a prolonged period of adjustment similar to past downturn cycles. With Trump issuing a new ultimatum and Tehran rejecting the demands, the conflict shows no signs of easing. While technical indicators suggest scope for a short-term rebound, gold's broader trajectory remains vulnerable, and further downside cannot be ruled out. As markets shift toward uncertainty and volatility, will investors continue to trust gold as a reliable store of value, or is this the beginning of a broader reset across all major asset classes? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.